changing political climate means more attention to all types of regulatory compliance, including 1099 reporting. Stick around while we explain why this is and what it means for you and your 1099.
Welcome to the AP Now podcast, the podcast that covers trends, insights, and emerging issues impacting every accounts payable function.
Hi guys, welcome. I'm Mary Schaefer, founder of AP Now, the place where you go for all the latest business intelligence you need if you work in, manage, or have responsibility for the accounts payable function. Today we're going to talk about 1099 reporting and why market conditions dictate that it is critical that you get those important documents, your 1099 MISCs and your 1099 NECs, filled out accurately and timely, unless, of course, you don't mind IRS scrutiny, fines, penalties, and lots of B notices. I want to start by making my case by sharing with you some numbers. And I have this little slide deck here. And let me see if I can make it bigger so you can see what I'm talking about. So let's dive right in and let's start talking about the first piece of information that I want to share. As you know, there are some new forms. Prior to January of 2021, when we were doing the reporting for 2020, all non-employee compensation was reported on a 1099 MISC. Then we had a lot of frauds related to 1099s and information reporting. It wasn't so much fraud on our part, but crooks who got a hold of the information and put in for phony tax refunds that the IRS set up two deadlines. You may remember that you needed, if you were reporting Box 7 income on the 1099 MISC, that had a deadline of filing with the IRS of January 31st, while the rest of the form had a date later, depending upon how you were filing. That created a lot of problems for the IRS when people filed the second time. It looked like corrections. It was a big mess. And so now the IRS, starting with the reporting that was done January 2021, had two forms, the 1099 MISC and the 1099 NEC. And that, while it made life a little bit easier at the IRS, or at least I hope it did, it was not so simple for industry and more specifically for the accounts payable folks who are doing the reporting. So now we have the two new forms, and the IRS has learned from the first year's reporting, and there already have been some changes made to those forms. Now, I want to share with you what I call these eye-opening numbers. To me, if this is kind of a no-brainer, except it's not, okay? The tax gap is estimated to be $1 trillion. Is it $1 trillion? I don't know. Even if it's only $800 billion, it's still a lot of money. So the tax gap is huge. Now, the IRS has done studies, and they have found that for every dollar Congress gives the IRS to spend on its operations, they get $5 back. Now, this is what I call the no-brainer. If it was me and you told me every dollar I gave you, you were going to give me $5 back, I'd be giving you every cent I could get my hands on, and then I would be reinvesting that money. Well, luckily for tax cheats, that's not what happens, okay? But you can see there's a compelling case here. Big tax gap. Hey, we spend a little money, we get some of that back. Now, before I talk about why the IRS makes such a big deal about information reporting, 1099 reporting, if you want tips or insights on a more efficient accounts payable function, or for your accounting, finance, and accounts payable career, I'd like to invite you to subscribe. And if you're watching on YouTube, please ring that bell on the top of the screen to be alerted to when we post new episodes, which is 2 or 3 times a week. Okay, now let's continue with our story. Why does the IRS make such a big deal about the reporting? Sometimes people say, well, if we get it wrong, they charge us fines and penalties. Isn't that enough? And the answer is no, it's not enough. And the reason that it's not enough is because the IRS can make a lot more money by collecting the tax that's owed them if you do the reporting correctly than they can make on your fines and penalties. So they really don't want your fines and penalties. I know, as hard as that may be to seem, but they're really not interested in your fines and penalties. They are interested in getting you to report correctly. And the reason for that is they have done studies, and they have found that if income is reported to the IRS, you are 95% likely to report that on your tax return and pay the taxes that are owed. versus if it's not reported to the IRS and you're kind of on the honor system, then only about a quarter or 25% of the folks report that income. Now, what those actual numbers are, is it 95-25? Is it 98-30? Who knows? But you can see there's a big difference there. And so this is why the IRS makes such a big deal about this issue. They want the reporting. They don't want your fines and penalties. Now, some of you may have read in the newspaper that President Biden has asked for $80 billion in his budget to go to the IRS for what he calls enforcements. Now, will he get that? I don't know. But even if he gets a portion of it, it's still a lot more money that's going to be focused on basically audits. And part of those enforcements are information reporting audits, the stuff that we do. Now, because this is getting to be such a critical issue, we at AP Now have convinced 1099 expert Steve Mercatante to do several 1099 webinars for AP Now. We'll have a link to those events in the show notes. Now, let me share that I think regulatory compliance is increasing, not only in the 1099 field, but virtually across the board. I just finished reading some of the memorandums that came out of the White House. And for example, it looks like there's going to be more Foreign Corrupt Practices Act reporting, etc. So you can see big issues on the horizon. What does this mean? What this means is more audits, more information reporting audits. That means more of our members and our listeners are apt to be audited. In the past, when we surveyed members at AP Now, we found out that only about 10% of them had actually been subject to an information reporting audit. We expect that to go up. The IRS will be more focused on 1099s. And let's face it, if you're in accounts payable or you're the person responsible for the 1099 reporting, you don't want to be the reason that the IRS is focusing on your company, okay? By the way, sometimes people say, well, how would the IRS know? Well, let's start off. If you get a lot of B notices, that's a red flag right off the bat for the IRS. And also sometimes when an auditor is in doing one type of an audit, they may look around to see what else is going on. Now, what else is going on? Okay, I want you to be aware that there's 1099 reporting requirements at the state level in many states, not all states, but in many states. And that number is only growing. And many of the states are not relying on what the IRS tells them. They're requiring separate reporting. Also, there is more cooperation between the feds and the IRS regarding information, etc. So this has the potential to be a really, really big deal. I spoke with 1099 expert Steve Mercatante, who I mentioned earlier, about some of the problems related to 1099s in episode 72 of this podcast. On YouTube, a link will appear to it momentarily to the left. As always, we appreciate your comments, your thumbs up, your subscribes, and your shares. Good luck.